another notion that you discussed with Senator Menendez regarding the risk of runs on a given stable coin. And here, just on a theoretical level, would a fully reserved stable coin pose a substantial risk of experiencing a run, or would that risk be higher or lower than, say, a fractional reserve bank? The risk of a run on a fractional reserve bank?
The fractional reserve bank is backed by either deposit insurance or lender of last resort discount window facilities that can, with regulation of the assets and the fractional reserve, can prevent runs. Fully reserved, for example, a money market fund, fully reserved 100% high quality assets have limited reserve run, but for payment. So the difference between stablecoin and, say, a money market fund is that a money market fund, in my view, is purchased for the purpose of earning yield. You purchase a stablecoin to be able to use it as a payment mechanism. So they're slightly different. So I think the redemption features will distinguish, a stablecoin from, say, a money market fund, a government money market fund.
I think as we look at this, we should be just particularly careful to.
That was a very specific question. How about this? Do you think U.S. government debt that underpins U.S. government money market funds is risky?
I do not. There is no credit risk. There can be convertibility risks if.
So they are risky, or they aren't?
There's no credit risk.
Okay, so then.
But there can be liquidity risk, just in the being able to execute the transaction.
The time I have left, Mrs. Liang, I want to thank you. Tokenized money market funds backed by government debt or highly rated commercial paper clearly would not impose prudential risks significant enough to reserve the issuance of all tokenized money market funds to banks. This is important to highlight because there is a void in the market between stable coins and security tokens, and a tokenized money market fund could provide an attractive, low-cost financial product with conservative returns. For this reason, I'm working on a nonpartisan legislation that would allow tokenized money market funds to come to market. Here's the bottom line. Banks should not be the only institutions in the ecosystem with dibs to issue the potential array of financial products that the President's Working Group report simply lumps together and ties as a stable coin. Thank you. I yield back the remainder of my time.
Thank you very much.
Hearing. I started off dismayed because I saw in the report put out that only banks should issue stable coins and they should be subject to prudential regulation. But then, surprisingly and happily, by the way, I've heard you a couple of times in response to some of my colleagues' questions maybe draw a little nuance to that particular issue. And I want to go back to a few things that you said earlier. Quote, the full set of bank regulations do not need to be applied to a stablecoin issuer that does only stablecoin issuance. There's flexibility in the insured depository institution framework, end quote. Next quote, stablecoin issuers that have a simple business model holding high quality assets would be subject to a less stringent supervision and regulation, end quote. I think these are really important points to make, that there is the opportunity for good stablecoin issuers, and I've met many stablecoin issuers that are very interesting, being good operators, good stewards, and good issuers, for them to have a lower regulatory model provided that they are wholly reserving for the issued assets. Can you talk a little bit about the type of assets that should qualify as high quality assets according to you?
Thank you for that. And those statements I made, I stand behind. The high quality assets that can meet the ability for investors or consumers to redeem their stablecoin should be cash, Treasury securities. It could be, if it were in the banking system, reserves at the central bank, which are the highest quality and then would also not have any convertibility issues on redemption. So that would be, I'm not trying to specify or limit what could be in that category, but just high quality credit risk-free assets.
And I think we would also want to make sure, not just high quality, right? 30-year treasuries are high quality, but we also want to make sure they're of a limited maturity, right? You've talked about run risk several times.
Yes.
Making sure that near-term maturity at par is important as well. Is that right?
I think that's an important absolutely important consideration, that short-term treasury bills convert much more quickly to cash than longer-term treasury securities. We found, at least in March of 2020.
Indeed. Well, and several times previous to that, and obviously you're taking less interest rate risk, shorter duration. So
Yes.
I guess my point here today, and I think you've elucidated it very well, is that we do have the ability to say, if you are going to be, I'll use your word, a simple stablecoin issuer, and you're going to fully reserve, and your assets are going to meet a certain quality and are going to be no longer than a certain duration, we should accept that even without prudential regulation layered over and above that, right?
I think there are regulations related to the operational risks of stablecoin for storing and transferring the stablecoins as payments, and that are more than just the consumer protection kinds of rules that the state money transmitter laws usually focus on.
Well, there are a lot of businesses that aren't subject to full prudential regulation that do those very things, though, right? I mean, we figured out custody of assets outside of banking alone and other issues related to, I'll call it the back end operations, that we could sufficiently ensure they operate without the full weight of prudential banking regulations, though, right? There are businesses that we allow to exist today.
Yeah, so the other service providers in the recommendation, those other service providers were not required to be, the recommendation was not to require them to be an insured depository institution. Right. It only applied to the issuer of the stablecoin.
Right.
As you know, it's part of a broader arrangement for it to function.
In my 20 seconds, I just want to make sure I hit this nail on the head. I think there is room for non-bank stablecoin issuers, provided that their assets are backed wholly and that they are of sufficient quality and they don't exceed a certain maturity. I think that we should find another avenue for this technology to develop outside of giving the exclusive power to banks themselves.
Thank you very much.
To operate within the regulated banking system. I have a question about the notion of regulating stablecoin issuers as banks. Suppose for a moment there's a stablecoin issuer whose reserves are verifiably backed by the dollar on a one-to-one basis, and whose reserves can be immediately redeemed for a dollar on a one-to-one basis. If the stablecoin issuer has no fractionalization of reserves and has no lending, it would seem to me that the stablecoin issuer is operating differently from a bank and therefore should be regulated differently from a bank. Undersecretary, even though the PWG proposes regulating stablecoin issuers as banks, do you acknowledge at some level that the absence of fractionalization and the absence of lending are relevant factors that differentiate stablecoin issuance from banking and therefore should differentiate stablecoin regulation from banking regulation?
I absolutely acknowledge that there are differences, and the lack of lending makes a stablecoin issuer different from a traditional commercial bank. The proposal recognizes or relies on the flexibility of current banking regulation to distinguish between those kinds of activities. That an stablecoin issuer that does not make loans would not be subject to regulations that would apply to institutions that make loans. The distinction about the stablecoin issuer is that it's more than just the redemption and creation of stablecoins, which the transparency and disclosure rules could apply to, but it's also about storing, transferring, using the stablecoin for payments. And that is,
in the interest of time, I just want to interject. The reserves of Tether, the largest stablecoin issuer, consist heavily of commercial paper shrouded in secrecy. The public has a right to know the names of the companies behind the commercial paper, and the countries in which those companies are located in order to fully assess the true safety of Tether's reserve assets. Suppose for a moment we were to adopt a rule requiring reserves that are 100% cash or cash equivalent. Since Tether has become one of the largest holders of commercial paper in the world, what unintended effects could a 100% cash or cash equivalent rule have on the commercial paper market?
So I believe this is similar to the issues that arise in the money market fund regulation. There are government money market funds and there are prime money market funds. The prime money market funds under new regulations have reduced their holdings of commercial paper, and commercial paper issuers have sought other investors. I think over time, the choice, the markets and the issuers find the right investors and reduce risk to the system overall.
My time has expired.
Because I need to have your opinion. In your written testimony this morning, you indicated that, quote, some have suggested that stable coins could be regulated either as securities or as money market mutual funds. Assuming that stable coins satisfy the definition of securities or MMFs, there is a further question as to whether these regimes would effectively address the prudential risks of stablecoins. And in your view, what are the parallels between MMFs and stablecoins, and what considerations would be helpful for us to consider?
Yes. So I think thank you for this question. So stablecoins, let me start with money market funds that invest in government securities, high quality securities, as if that was the pool of assets backing a stablecoin. Their investors purchase those with the expectation of earning the yield on the underlying assets. It is an investment asset. A stablecoin can be purchased and used for payments, not necessarily investment. And that's what makes stablecoins unique. They are that bank-like product that the SEC chair referred to, as well as an investment-like product. And that's why we believe there was a regulatory gap for which a new framework should be considered.
Gentleman's time has expired.
And I think we've got an opportunity here to recognize that by saying that if a stable coin is dollar for dollar backed with currency, it's redeemable at par, there's good transparency, we can regulate it in a way that is different than a much more risky instrument. And we've talked about this, but I wonder whether you would agree that full IDI regulation, bank charter, may not be necessary in that former case.
So I agree there are important distinctions between stablecoin and the unbacked digital assets. I also agree the full set of bank regulations do not need to be applied to a stablecoin issuer that does only stablecoin issuance. There's flexibility within the IDI framework to not focus on credit risk of making loans, because the stablecoin issuers do not make loans. They don't engage in fractional reserve banking. But they do have payments, and there are operational and convertibility risks that are associated with that you would like some oversight to ensure that the payment system continues to operate well, which is a public service to the financial system. And so that is the core of the PWG recommendation.
Yep. No, and I appreciate that. And I appreciate the way we've had a couple of conversations about this, the way you're thinking flexibly, because I really do think our sole job right now is to figure out how to adequately regulate instruments which can be very, very safe or potentially very, very risky. And that's actually an exciting endeavor, I think. Let me use
currencies. Your report suggests that we should treat all stablecoin users as banks. Now, this would give massive advantage to all of the institutions who are most skeptical about cryptocurrencies in the first place, and leave behind the entrepreneurs that have worked to make cryptocurrencies more mainstream. It would guarantee that the largest banks in the country have built in advantage over other market participants who may not have the resources to comply with the minimum regulations that are coming. So this would give the largest banks an even greater advantage in this developing space over every other entrepreneur that may have been doing this much longer. So, Ms. Liang, how did the working group balance the effect on innovation as they came up with these recommendations?
So thank you for the question. Of course, the group was very focused on balancing the benefits for financial innovation with reducing the risks to users and the broader financial stability of stablecoins. I believe that stablecoins, because they offer stability, should be held accountable to actually be able to provide that stability when demanded. And that requires more regulation than they currently are under. While the proposal was for stablecoins to be issued by insured depository institutions, the proposal was also relied on the fact that regulation and supervision of IDIs can be quite flexible, and that stablecoin issuers that have a simple business model of holding high quality reserve assets and issuing liabilities such as stablecoins would be subject to a very much less stringent type of supervision and regulation than would a traditional commercial bank.
Okay.
So I think that the PWG, came out balancing the risks that could be reduced by that framework while providing clarity and consistency and safety that would be beneficial for innovation.
All right. As you developed this report, you sought the input of the regulators, academics, private sector participants. And as a business owner myself, I value the input of the private sector. I think it's the most important. And since most people who took risk to build these new products and provide services are private sector, they are the ones who took risk and have the most to lose if the government gets this regulation wrong. So in closing, can you describe your work in consulting the private sector as you developed this report, and do you think their voices were adequately accounted for?
We did reach out to many stakeholders, including academics, regulators, and private sector. We talked to many of in the industry to hear their concerns, to learn more about the actual business and the problems that they face. I think many of them are comfortable with the idea of a IDI bank charter. Some are pursuing it. Some are already within the regulatory perimeter, even on their own. So I think, again, we're balancing innovation with safety, trying to find the right balance. I think this recommendation is one path forward. Of course, Congress will determine how it wants to write legislation. We believe this element could be very beneficial to the system. Product or the service?
Yeah, I agree with that. Just my time short. I'm an activities-based person as opposed to jamming everything through entity regulation, particularly in an innovation, which is the jury's out for me on whether these have to be issued by a depository institution, for example. I don't think you're wrong to suggest that. But would you support a federal money transmission license or a national payment provider license that would be a national license similar to what we see in the EU? Is that an alternative that you would accept?
I think that is a possibility definitely worth exploring. The US does not have a federal money transmitter license, and so we did not build on that framework.
Yeah. Well, and that gets into this issue Mr. McHenry asked about state regulation. Are you supportive of states going ahead and defining some of these quality standards around stablecoins as we've seen in the instance of New York?
I think in the current environment with stable coins already in play and growing rapidly, the current regulators need to take actions to meet their mandates. As I understand it, some state money transmitter licenses don't even apply to digital assets. So it feels like there's probably room for different states to be revisiting their rules.
Yeah, thanks. And on the subject of deposit insurance, I agreed with a lot of the comments that I don't really think that's the right road to go down for these assets. I think defining them is a much better approach, whether they're used as a transaction payment activity or as an investment holding activity, and that we just use activity-based regulation based on the definition. As to whether or not they're systemically important, that seems a stretch for me at 150 billion or 170 billion. When you think about, we have 5 trillion in credit card transactions a year, and we have almost 5 trillion in money market funds. So to me, I thought that was a stretch. I encourage my colleagues to let's work together on a narrowly crafted definitions bill for what's a good stable coin. Thank you for your time, and I yield back.
Thank you very much, Mr. Hill. And
power. Now, the principal recommendation is that stablecoin issuance be limited to insured depository institutions. Now, I commend the contribution to the public discussion that the PWG has contributed, but I strongly disagree with that particular recommendation. I think we can protect against concerns such as run risk through a less restrictive and more appropriately tailored approach. So to accomplish those objectives, I released a set of guiding principles for stablecoin legislation. These principles recognize that stablecoin issuers have significantly different business models than banks, and they present different risks. For example, stablecoin issuers typically neither make loans nor deposits, nor take deposits. They may choose not to transform maturity or to intermediate credit risk. And as such, stablecoin issuers using cash or cash equivalents to back its coin is likely safer than most existing financial institutions. Because of these differences, it would be inappropriate to subject stablecoin issuers to the full range of bank regulations meant to address risks posed by the fractional reserve deposit and lending banking system. So I was encouraged that Ms. Liang has recognized these differences and sensibly agreed that there should be regulatory flexibility for stablecoin issuers not engaged in traditional banking. But that does raise the natural question: why require all stablecoin issuers to become insured depository institutions then? My legislation will take a different approach. It will provide regulatory treatment that is flexible and adaptable to future technological innovation. It'll also promote competition in the stablecoin market by allowing at least 3 types of regulated entities to issue stablecoins. First, my legislation would preserve the regime to which the majority of stablecoin issuers are currently subject as state-registered money service businesses and money transmitters. To disrupt this regime would both introduce unnecessary burdens to an emerging technology and unwisely diminish the success of states with experience and expertise in this area. Rather than discard this regime, we should build on it to ensure the public has the right disclosures about stablecoin reserves to make an appropriately informed decision about whether to use any particular stablecoin. Second, my legislation will clarify that insured depository institutions are actually, in fact, permitted to issue stablecoins. The former head of the OCC, Brian Brooks, pioneered work to give banks clarity on digital asset activities, but the current OCC has created confusion regarding permissible activities. Finally, my approach will establish a new stablecoin charter with regulatory requirements designed specifically for stablecoin issuers. The requirements will address the risks identified by the PWG report, but will not force stablecoin issuers into a one-size-fits-all system created for traditional banks. Ms. Liang's recent testimony indicates to me that I think she agrees with the idea of a tailored approach for such issuers. Rather than just rely on the flexibility of the existing framework for depository institutions, which leaves full discretion of bank regulators, however, I think it's the responsibility of Congress to design this approach. So these 3 paths would allow each stablecoin issuer to choose the regulatory framework most appropriate for its own business model. Now, under this legislation, each stablecoin issuer would be required to meet certain minimum requirements regardless of the charter or license. For example, all would be required to disclose the assets that back the stablecoin. All would be required to adopt and clearly disclose redemption policies, and they'd have to undergo third-party audits. These requirements would ensure that consumers have sufficient information to choose which stablecoin they use. Ms. Liang's thoughtful comments on stablecoin regulation lead me to believe that there are many issues on which we can find common ground. So I look forward to developing legislation with my Senate colleagues and working with the administration to establish a regulatory framework for stablecoins that addresses potential risks while also encouraging innovation and competition. Thank you.
And ask about the recommendation in the President's Working Group report on stablecoin issuers that it should only be limited to insured depository institutions. With respect to the insurance requirement, is it the case that the FDIC and NCUA have found that stablecoins and their assets are insurable? And have these agencies committed to provide deposit insurance to newly chartered de novo institutions that issue a stablecoin?
So thank you for that question, Senator Lummis. The proposal for stablecoin issuers to be insured depository institutions, given the flexibility of that supervisory and regulatory regime, does not necessarily mean that stablecoins need deposit insurance. I think that would depend on the circumstances of the backing and the functionality of the stablecoin that is being provided. So the proposal is not, and the PWG did not recommend necessarily that stablecoins be backed by deposit insurance.
And what other types of backings would you believe adequately protects the consumer?
So I think the consumers can be protected with reserve assets that are truly high quality, that will provide some, reduce the risk of runs by investors. There's also the protections provided by oversight of all the entities that go into providing, supporting stablecoin as a payment. So the custodial wallets, the custody, the other ways of of liquidation of the redemption of the stablecoin that can be provided. So I think all those go into protecting consumers when they want to use stablecoin for payments.
So since there are alternative ways of bringing stablecoins inside the banking perimeter, like 100% reserve bank with tailored holding company supervision, is that something you discussed and are willing to consider?
Yes, I think bringing stablecoins into an IDI framework that is adjusted for the risks of the stablecoin issuer, which would include solid backing of the stablecoin, one for one, would certainly be an option.
Well, I'm so pleased to hear that that's your approach, because without it, I think the type of competition that Senator Hagerty wants to protect would be at risk if someone already has deposit insurance and can issue a stablecoin like, J.P. Morgan's JPM coin. That would seem to limit competition in that marketplace to only the very, very largest banks in our country. And there may be other options that other institutions could explore. And it sounds like you are willing to discuss that with them. So I'm going to
regulations, but also think it's important to avoid one-size-fits-all regulations. Specifically, we should not be broadly applying banking regulations to stablecoins. So does the administration intend to account for the significant differences between depository institutions and stablecoin issuers in its regulatory approach? Am I understanding that?
Yes, that is our understanding, that the banking regulators have flexibility to adjust the supervision and regulation that would account for differences between stablecoin issuers and banks that also make loans. So it would be a different approach.
Thank you. And